Now we'll turn to the refined products and go a little bit deeper on, what do we think is going to happen as we go through the remainder of, the shoulder season? What does it mean going forward, especially given that huge drop that we saw in just product getting pulled into the system? So this is why we always look at that 4-week rolling average. So the current backdrop is 13.592 million barrels a day of demand versus last week's 12.4. So clearly we had that snap back, and the average is coming in at that 13.448 million. And that's where, when you look at that solid yellow line just right between at that, let's call it 13.5 million, we think that there's going to be a little bit of an upside to that as we start to get closer to 13.6. But as we see gasoline demand going up, we think that there's going to be that loss of, or at least a reduction of propane, the reduction of diesel along those seasonal norms, which will keep us range bound. And again, even when you look at gasoline demand starting to get a little bit better, we have to weigh what is weekend demand, what is weekday demand, and how does that start to close the gap? Because that's where we're seeing some of that missing demand that really hasn't come back fully, and we don't really expect it to come back at least as we go through March and April. And then we'll have to look at what are some of the companies saying in June and July in terms of people coming back into the office. So now let's just take that and let's look at what happened in distillate. So obviously distillate had that big drawdown of 9.7 million barrels. Clearly it was driven by PADD 2, PADD 3, obviously PADD 3, 6.9. And then you had that impact into PADD 2 of about 2.7, 2.8 million barrels. And again, there was a lost pipeline coming from PADD 3 into Chicago, which is that PADD 2 side, and then from there it gets pushed into the market. So by taking that pipeline down, and not that they did it by choice, it was just the power outages, you lost that flow through. So then you pulled from storage in PADD 3, you pulled from storage in PADD 2. But that will start to abate. But even with that big draw, we're still above the year over year by 8.5 million barrels. And if you look at the 5-year, we're now back below that 3.6, the 5-year average by 3.6 million. That's something that will start to reverse. But again, even though the draws will go down, we're still going to get another draw next week. It's just it won't be to the same level just because exports will remain low. And we do have a continuation of imports coming into the market. And that's why we look at the import market, where, as we said last week, we saw some ships sitting offshore in PADD 1. They're starting to come onshore, which is why we still have that so total imports were up 20,000 barrels a day, but that's still over 195,000 barrels a day versus last year. And into PADD 1, it's over 208,000 barrels a day over last year. So again, there's going to be that continuation as that arbitrage open. There was a huge cold snap that came through, obviously, large parts of the U.S., and that pulled down diesel, that pulled down heating oil. So that's now going to be replenished as that opened up an arbitrage that is coming into the market. But the arbitrage is still there, and it's starting to close, but again, it's still there. When you look at gasoline, diesel flows to the U.S. surged to a total of about 2 million tons in February. About 1.86 million tons of those shipments are still underway. So it's very, this is why we keep saying there's a lot of product that's still coming, because it's anywhere from a 2 to 5 week delay from when it's actually purchased to when it shows up, based on port of launch. How quickly can it get into one of our slips? These are things that take time. And then for March, 4 tankers have sailed so far with a total of 146,000 tons on board. In addition to 21 tankers have been booked so far to load, haven't loaded yet, of another 823,000 tons. Again, there's going to be a lot of product, and it's being supported by the draws and the opening of the arbitrage, but it's going to be a matter of how quickly do they get here and how quickly do our refiners come back. So then when we look at yield, even though they obviously they went down, there was still that production pickup, and they're still looking to build or to produce more gasoline versus disti. So this is going to be a place that we'll see a bit more drawdowns in the near term. And this is just showing on the reduction of demand. This is what we were saying, where we thought it was going to come back down. It had an overshoot to the upside. Now it'll have an overshoot to the downside. But based on the competing factors, will still be around that 5-year average. Just because even though heating demand has gone down, we still have trucking demand. We still have a very robust trucking demand. And again, that will be that support for some of those diesel moves. But if you consider about how much is a truck burning versus how much is it refilling, how much is this going from storage back to the distribution centers, that's where we'll get some of those noise, which is why we talk about the 4-week rolling average. Then when we look at, obviously, the internet truck stop, you still see the huge spike in the load factor. And this is that residual that remained post Texas. There were a lot of accidents on highways, interstates, and then just trucks that couldn't unload and then get to their new place to pick up their demand. So this will start to come down. And the reason why we're saying that is when you look at rates, rates obviously are moving up just as diesel prices move up, but there's really nothing to see in terms of that move, that spike higher. It'll start to come down because if that was real and going to stay there, then rates would continue to just start to go, parabolic, if you will, just given based on where that demand is. So again, this is just more of that noise in Texas that is going to start to reduce over the next few weeks. And then when we look at rail, as we were saying last week, that huge drop was going to reverse. And here we're seeing it, as we were saying, grains was going to be the first place it was going to reverse because there's a lot of grains going off into the world. So grains, again, is going to remain strong. Chemicals is going to start to rebound. And the reason why they went down is not only refiners went down, but also propylene production, chemical production, so that will start to reverse as well. The one that we remain more bearish on is the motor vehicle, non-metallic minerals. That's the one that's going to continue to struggle. Petroleum and petroleum products will start to rebound. It's not going to get positive versus last year, but again, we're going to start to see some of that normalcy. And then on the intermodal side, we were saying that we were going to get that spike and then we were going to settle back into that high single digits. And this is where we are. We had that spike to 11.6. Now we'll start to normalize back down on the intermodal side, but total traffic will remain elevated versus last year just because we do have more cargoes and the reopening of Pad 5, more specifically, obviously California, is going to allow some of that, some of those bottlenecks that have existed to start to open up and move product into the throughout the U.S. And here's a perfect example of it. So when we look at February through March 6th, you can see that there was an elevated move in terms of just how much stuff is coming into the system, But then when we look out into March, you're starting to see some of that drop, and we actually saw some cargoes go from March 14th into week 10. Just because they're starting to open back up, and that's allowing a speedier move through the port, which is, again, a net positive to getting some of these containers back into the market, which whether they're empty or full on the backhaul, just to try to normalize because the supply line delays are massive, and we're seeing them in the ISM numbers, the PMI numbers, which we'll talk about in the Econ show. Now, when we look at heating demand or heating degree days, here you can see obviously there's a nice little warm spell coming through a large percentage of the country that saw the big cold snap. So again, this comes to that diesel demand that's going to come down. But as the weather gets nicer, especially into the 50s, you're going to see people going out to the parks more, driving a little bit further distance to go out, bring the family out. So again, that's going to be a net negative for diesel or heating oil demand, but a net positive for gasoline. So there's going to be that give and take as to which one overtakes the other. Now, obviously, gasoline had a massive drawdown of 13.6 million barrels. You can see that obviously coming full circle to the same pipeline moves all refined products. So here you see Pad 3 that was down by 11 million barrels and Pad 2 down by 2.3. That will reverse, especially when we look at not only just imports but also just yield. Where we had a big increase in refiners that are targeting the gasoline production side, just because this was expected. And now just the arbitrage in general, like why would I export it when I can sell it internally at such a healthy premium? And that's why you're getting the refiners that are going to be incentivized to make gasoline for our market. But at the same time, if it's good prices for us, it's good prices for everyone. And that's going to continue to pull into the market. So when we, as we were saying, we had gone back over the 5-year average. Now we had a huge drop down. We're 8.2 million barrels below the 5-year average and 8.6 million barrels down below year over year. Again, that's something that's going to start to reverse. Because when we look at Pad 1, so Pad 1 is well over the year over year and 5-year average of gasoline and storage. But when we look at Pad 2 and Pad 3, they're now well below. So the imports will keep Colonial reduced in terms of what's coming from Pad 3 to Pad 1, and it's going to be shifted over into the Mid-Con. But with that being said, there's still those flows that are coming in, where when we look at gasoline imports, they were up 76,000 barrels a day. And when we think about the year over year, that's up 96,000. We're well over the 5-year average into Pad 1 and into the U.S. in general, especially on the blending component side. So again, that's going to mitigate some of the drawdowns, which is why we're still going to get a draw. It just won't be as excessive now that we've seen this backfill into the system. And then, as we were saying before, European oil product exports to the U.S. Are at a 3-month high in February, which again bleeds into March. Total fuel flows, mostly gasoline and blending components, which is what we're focusing on here, rose to about 3.1 million tons aboard 78 tankers last month, which is the highest since November. So again, we're going to get that backfill coming to the system. Now, when we look at just where blending components are, clearly we're still at an all-time, near all-time highs, even though we had that drop down. When you look against the 5-year, it's a bit more of a normalization. It's just there's still an excessive amount because even before this, refiners were targeting summer-grade gasoline, which is more octane, more blending components. So that they're still going to stay the course and make that gasoline because it does have that higher premium going into the market. So here's what we were talking about, where we expected that bounce in demand, but not back to the highs that we saw previously. Now, with that being said, there's still going to be another move up just because we're not done yet in terms of getting some of this product into market. So we think that there's going to be another move up into the bottom of that cloud, and then we'll start to see that normalization along that 8.1 to, let's call it 8.2 million barrels a day, as we've been talking about into March. And just when we look at that 5-year average, again, at this point, 15-year average, and this is why we always talk about it against the averages, we normally see a steady increase through the time period, and then we start to see a little bit of a slowdown. But again, this is why we think that this is not too crazy to see, especially as the weather gets a little bit better. On the propane side, there were a ton of issues in terms of not only production, but also just demand. But even though we lost production, we also lost propylene production, which is taking propane and making propylene. So by losing both, it offset a bit. So it wasn't as drastic as a drawdown as some of the others, but we're still seeing that propane being moved into the market. Clearly, we're down another 2.25 million barrels, and you can see that it was a pretty steady drawdown across the board. And just based on where the demand is for propane, we don't see this changing, or at least staying at the very bottom of the cloud over that 5-year average. And the reason why is, when we look at just residential propane prices, this is just looking, based on what happened from the Texas freeze-off. You can see that the residential propane prices have pushed up. Again, just more consumption, but at the same time, that tightness is going to create that propane, which is going to incentivize and really support some of this NGL basket over the next few weeks. And then when we look at wholesale propane prices, you can see that they've just gone parabolic. And now they won't continue that essentially the vertical move, but it'll still remain elevated as it starts to go sideways, because even though there is a lot of weather impacts, the demand is real and it's not really going away. It'll get reduced as some of the heating demand goes down, but that will be replaced by the amount of new propylene facilities coming back after the freeze off, which will kind of counteract some of that lost residential demand. And then when we look at just the U.S. in general in terms of activity, we have a steady move down in COVID cases, which is a positive. COVID deaths continue to move in the right direction. Lockdown index is getting reduced further. We're still over 50, but we're getting closer to about 55, 60, which again is going to be healthy in general. Jobless claims continue to remain elevated. The ADP number is disappointed to the disappointed versus estimates. We'll talk about that in the econ show. So there's something to watch as we go forward, and especially when we look at public transport usage. That remains weak. And then airline passengers are seeing that seasonal jump. But again, we have to think about how does that compare versus last year. Then when we are thinking about overall flows, again, we want to just rehash that European gasoline arrivals into the U.S. jumped by 65% week over week. Gasoline imports are continuing to surge. And these are things that are going to remain elevated into the system in general. So that's going to be a support network, if you will, that will help backfill across the board. Now, when we look at U.S. Dallas Fed mobility and engagement national side, so here you can see that big move up, and this is now post the Texas blackout. So you can see that we're now back to the highs that we were at, right at the beginning of the holiday season. And this is just really being driven by, we still see that recovery on the weekend side, but that slowdown on the weekday. And here you can see when we got to that low end, that was obviously the Texas blackout. And I shouldn't say just Texas, because there was 73% of the U.S. was in some sort of freeze and or snowstorm. So again, that hurt the impact, the activity. But even on the spike, we're still measured in terms of that move higher, and that's why it's still going to get better. It's just the lows they will have higher lows, and we won't have so much higher highs. It's just we're going to continue to get closer to this down 19%, down 18% in general. And this is putting into perspective kind of what that looks like using Gas Buddy data. So you can see the week, that nice bounce that we had off of that really terrible week from the Texas freeze-off. So just coming from Gas Buddy, weekly demand was up 15.3% from the prior week, which was down 10%. So again, nice bounce, overshooting where we were in the Texas blackout, but was also up 3.8% from week ending February 13th. So again, this is that net positive. So U.S. gasoline demand for through Friday was the highest of any day since October 30th, and the third highest single day since the pandemic started. That's that overreaction to the upside. Now we'll start to see that settle back, but we'll still stay at that elevated level. Now, looking at it a bit differently, U.S. gasoline demand jumped by 1 million barrels, according to Discard, which had us up at 8.76 million barrels a day. And it's just going to be a matter of, they had 4 weeks of decline, a spike back. Now, as people went out and got food, delayed getting groceries, that will start to abate and will start to come down. But nicer weather brings people out, and that will help support some of the activity. And this just puts it into perspective as to where we are. Even after that spike up, we're still at this flatline level. We're not back to where we were in March, but you're seeing this kind of steady increase. And now this is where we think that we go sideways from here, which when we look at some of the Google data, you can see here some of that Google capacity in going into the grocery store, but parks is starting to get some love. That will continue to go up, especially as the weather gets warmer. But when we look at retail, workplace, transit, we're still in this lull that we can't seem to snap out of, and it's starting to reverse, but again, it's reversing to a lower normal, and that's where we remain concerned in general as we go through the remainder of the shoulder season. But when we look at Apple activity, it's supporting what we've seen, where we do have that nice spike in the U.S., up 11%. But when we look at Europe, we're seeing some of the stabilization at these reduced levels, and we'll talk about that more in a minute. On the positive side, daily tests have gone up, as we've been saying, just in terms of March. When do people feel sick, get sick? It's going to be in that seasonal transition. So I would expect to see a bit more tests as people remain cautious. If they start to feel sick, they'll go get a test, which will then pick up more cases. But we're not going to, obviously, we're not going to see that spike that we saw post the holiday or before the holidays. People tested before they left. It'll be a little bit of a spike, but it just won't be to the same level. And then just based on the amount of people getting vaccines, the currently hospitalized is just going to continue to go lower. Same with those deaths as that transition moves through the system. Now, when we look at the U.S., we're seeing a steady decline. Again, we're starting to see a little bit of a level off, but it's still, the decline is still going. It's just the pace of the decline has slowed. Europe is a little bit stickier just because we've seen a little bit of an increase in Germany. Not a frightening amount, but it's still an increase. And that's something to be watched. While in France, as we've gotten into February and into March, you can see that we've had a fairly steady increase in cases in France. So that's going to be something of interest as they look to, now they haven't gone into a lockdown, which is a positive, but will they restrict some movements just in case? India, it's a bifurcation in India. Some places are seeing a slowdown, some places are seeing an increase. You can see here that they're essentially netting off, but we're starting to see a little bit of a decline, which is, again, a net positive. While in South Korea, we had a little bit of an increase, where Japan continues to see a steady decline overall. So that should be supportive of Japan, and South Korea will continue to see a little bit of an overhang on local activity. But when we turn to vaccines, we continue to see an acceleration. Now, I'm showing this chart just because the other chart that we had showed had a bit more of an impact from the Texas slowdown and just people that were stuck and had to miss their appointments or change their appointments. So now we're back in action, and we're seeing another acceleration of vaccines, which is a net positive. Johnson & Johnson vaccines are showing up. Again, just adding another tool in our arsenal to accelerate some of these vaccines and get people feeling a bit more comfortable about getting into the market. Now, when we look at jet fuel, again, we saw a small decline of 2.5 million. But when we look at just that demand level, we as we were saying, we weren't going to get back down to this low, but we were going to stay within this range, just as we'd get some increases in some places, some declines in others, and this will keep us in a fairly tight, let's call it, anywhere from 900 to about that 1050 level as we go through on an average. And it's really just being driven based on what we're seeing in the market. So when you look at, obviously, inclement weather is going to keep flights grounded. Those have now come back, which is why it's not surprising to see some of that jet fuel get pulled back through, just because some of those deliveries might have been delayed. So we had some flight increasing in the U.S. The residual has come back in China from the slowdown post Lunar New Year. But when we look out going forward, there were some 1,700 more departures. China and U.S., mainly Texas, led the increase. Scheduled departures over the coming 2 months declined slightly, though, and it was really driven by Europe, because Europe has cut about 1,700 more departures on average each day, week on week. And that's a little bit more of the overhang as we go into April. And then China, then scheduled departures over the coming 2 months declined slightly. Again, Europe being the biggest piece of it, because we have pretty much stable levels in the U.S. China has increased their flow, but Europe remains the problem in terms of getting back to this global normalcy, if you will, which, again, we don't think is going to happen in the year of 2021. So then when we look at passengers, the one thing that we want to look at is when you look at 2019 into 2020, well, you have that step change up in March, and we're getting that same step change just at the same percentage decline versus the previous year. So even though the average passengers are now sitting there at let's call it 700 to about 1.2, it's still the same thing that we saw last year. So you have to think about this against the seasonal averages, because in March we start to get closer to spring break. people start get have a budget to use. They start to get a little bit more active in travel, especially as the inclement weather starts to abate, and then you start to get that snapback. So that's also something that we saw is people who were stranded, their flights took off, so they were able to get registered through. But we'll still see this step change up hold through March, which will keep us, again, that demand a little bit elevated. And then, as we were saying with Open Table, we continue to see this trend higher. We're going to start to hang out in this level, especially when you think about where we were in the summer. That's where we think we're going to stay on this elevated level. The overhang will be more Europe, so the downside could be a bit bigger depending on how long they stay in some sort of restriction. So globally, as we were saying on the weekends, we're going to stay between this, let's call it down 35, 40%. But when we look at the weekday, we're going to get closer to down 50%. So that's really being driven by the US. That's seeing a bit more normalcy. Obviously, Australia remains strong, but Germany, Ireland, UK will stay sluggish just as those restrictions remain in place. So again, there's a lot of things to consider, but net, we're going to see an additional draw next week. It won't be as precipitous as this one, but it's something to look for as we go into the residual impacts from the power outages and just the inclement weather starting to normalize. Now, in the next segment, we're going to go abroad and look at what's happening in the international markets and what should we expect as we head into the OPEC meeting.